Hey guys, welcome back. If this is your first time here, I'm Neil, the Adventures Investor, and on this channel we talk all things investing, property, shares, and anything in that sort of nature. Today I'm going to be doing a follow-up video to a previous video where I was talking about a particular company listed on the NZX, and that is MCK. That's the ticker code if you want to check them out. Millennium Copthorne Hotel is the company. They're a hotel operator throughout New Zealand. They own and operate 20 different hotels in New Zealand. They also have a property development part of the business, which they're a majority shareholder in, 66% shareholder of a company called CDL, which is also listed on the NZX. But like I said, I highly recommend you check out my other video if you want to know a bit more about the company. Today we're going to be looking at trying to establish a value on this business, or company, sorry, let's say, and you know, a price that we're happy to pay for the business, and we want to get that at below intrinsic value. So we're going to be using a discounted cash flow analysis. This is something that Monish Prabrai and Phil Town and Warren Buffett, they all use some form of a discounted cash flow analysis when they're trying to establish the value of a business. So we're going to be doing that today. We're going to be using a website called TradeBrains. I've used other videos in the past where I talk about this particular website as well. I'll be leaving links to everything in the description below, so you can do your own calculations and everything on any particular stocks, or even MCK if you want to sort of run their numbers as well. And then I also use Phil Town's payback time calculator as well, which I've also made another video on, so check that out if you want to sort of run through the numbers on that as well. I'm just going to be pulling all the information off Yahoo today, and QuickFS as well, which are two great tools to sort of use when trying to just pull the numbers off the balance sheet and the cash flow statement of the particular company that you're looking at investing into. So that's what we're going to be doing today. But like I say in every other video, I'm not a financial advisor. I don't know your financial situation, so everything today that we discuss is purely educational, okay? I don't want to persuade you in any way, especially with this particular company. There isn't a huge amount of daily volume traded on the stock, so if someone was to start buying up large within this company, it would start putting the share price up, which you don't really want to do, okay? When you're buying into a company, you don't want to sort of start putting the price up yourself just because you're buying large amounts of this particular company. So something to bear in mind, there is not a huge day volume on this particular stock, so something to bear in mind, okay? Majority owned by another parent company that owns a 75% share of this particular stock as well. So that's something to bear in mind before you start investing into this company as well, okay? But do all your own research on this, okay? This is just things that I've learned from reading over a lot of the different financial reports and all that sort of thing. So like I say, do your own research or talk to someone that is specialized in that area, okay? All right, so let's jump into it. All right, guys, so we're at TradeBrains. I'm going to leave a link to this description and below. Highly recommend you jump on here and use this calculator to do your own calculations, or even not for MCK or any particular company that you're looking at. Great resource to use when trying to establish the intrinsic value of a business. I find the discounted cash flow analysis probably the best sort of calculation. There is a few different variations to this calculation as well, depending on who you talk to or what book you read, but I find this one quite a good resource myself. As there's no sort of set, because you're trying to extrapolate what the company is going to be doing in 10 years time from now, which no one knows. So you're just trying to get a good gauge on where you see the company in 10 years from now, and then work your way back to a price that you're happy to pay today with a good margin of safety. So that's what we're going to be working out with MCK, Millennium Copthorne. So let's scroll down and have a little look. I'm going to be using Yahoo Finance today to pull the numbers off, but to start off with, we're going to be getting the free cash flow. Just before we kick into it, I've already input the numbers here, and I'm just going to quickly show you where you can pull them from the statement, so you can do this yourself if you're wanting to establish the intrinsic value of a particular business or company that you're looking at investing in. So we're going to start with the free cash flow, and just bear in mind I've dropped the last 3 zeros off all these numbers as well, which, I mean, you can put the full number in if you'd like, but I just like to drop the last 3 because then I can just copy and paste the numbers direct from Yahoo or wherever you may be getting the numbers from. Okay, so that's what we're going to be doing today. So free cash flow, we are going to be going over to Yahoo for that. And here we are, Millennium Copthorne. Scroll down. We're looking at the financials and then the cash flow statement, okay? Then we're going to scroll down here to the bottom, and free cash flow, this is for the trailing 12 months, coming in at 64,793. So if we go back to our calculator, you can see that there. Total cash. So total cash, we want to be getting that from the balance sheet, okay? Same again, Millennium Copthorne, scrolling over to the balance sheet. So let's scroll down. Just bear in mind, guys, this is of 2019. This is not the latest statement. So if you're wanting to do the numbers, you may want to look at the latest report. But today we're just going to be using Yahoo because it's nice and easy just to pull the numbers off. And we're going to be pulling the total cash. Okay, so we're going to take the total cash, that number there, 217,118. And that will go into there. So that's the total cash. Now let's have a look at the total debt. So we'll carry on down. That's the assets. Now we're going to scroll down and look at the total liabilities. Okay, so here we have 201, 201. As you can see, they have enough cash and cash equivalents on hand to pay out all their debt. Okay, this is a great sign. This is both short and long-term debt. They have enough cash on hand. If they wanted to, they could pay off all their long-term and short-term debt. So we'll go back and make sure that's the right number there. And there it is there, 201, 201. And total number of outstanding shares. So we'll be using Yahoo for this as well. Here we are on the statistics part of Yahoo. Scroll down. And we're looking for total shares outstanding. So here we are, shares outstanding, so 105 million. That's what we're going to put into our calculator. Just a couple of things here, held by insiders, okay? There's a couple of things you want to look at and held by institutions. So you can see there's not a huge amount of shares, open for the retail shareholders like myself or yourself if you're wanting to invest. As majority of the shares are held by their parent company. So Millennium, which is their parent company, they own majority of the company, and the institutions own 13% as well. So let's go back and put that in our calculator. So there we have, we've got the numbers in. Like I said, I've dropped the last 3 zeros. The expected growth rate, this is something that you want to spend a bit of time on. We're going to go over to Quick FS here, and I'm going to show you just quickly how I've come with 5%. This is what we expect the business to grow year on year, 5%, okay? That's the number I've sort of gone with. I've looked over the last sort of 10 years down the bottom here, return on assets, return on equity, return on invested capital. And as you can see, 5 is probably a little bit, not so optimistic, which I prefer when I'm trying to establish the growth rate of business. I prefer to, if I'm a little bit hesitant, I will, ease on the side of caution rather than being overly optimistic when trying to, have a guess at the expected growth rate. But we can look over the last sort of 10 years. Obviously 2010 wasn't great, but generally from then on in, they've sort of been on average, as we can hear, we said the 10-year average is up here. Return on assets 4.9, return on equity 6.2, and return on invested capital 5.4. Revenue's been growing, assets, free cash flow, and earnings per share, all very solid fundamentals here. So that's how I've come up with the 5% growth rate for the business, okay? So there we have here. Discount rate, I've come in at 10. The free cash flow multiple for terminal value, I've come in at 10 as well. I use this off Modus Provide. He says, use 10 if it's more of a lower business, and then if it's more a company like, let's say, Apple or Google or some of these big tech sort of giants that are just absolutely have a lot of free cash flow, then he would use a more 14, sort of 15. But I've gone with 10, and this is just trying to get a value if the company was to liquidate 10 years from now. But the company obviously will still be there. Well, you want to hope the company's still there in 10 years from now, but that's just trying to give us a terminal value of the company in 10 years from now. Now, margin of safety down the bottom here, I'm going to give us 50% margin of safety. But with this, you're happy, if you're happy with 10% or 20, 30%, whatever it may be, then you just put that in there. But today I'm going with a 50% margin of safety. And this is what Warren Buffett and Monish Pabrai and Phil Town, all these big value time investors that I like to look up to and learn from them, they always, try and say if you can get a business at, 50% below intrinsic value, you're off to a good start, and you've given yourself a good buffer there, if your calculations aren't too bang on. And so like I said, do your own research on that one, whatever sort of margin of safety that you're happy with. But today we're going to go with a 50% margin of safety, okay? Here they say, if you just have a quickly look at that, they say, a 10 to 30% discount on the intrinsic value can be considered as a good margin of safety. This is in order to give yourself and your assumptions a benefit of the doubt. So this is like calculations aren't quite bang on. So let's scroll down and have a quick look at what this is coming in at. So the intrinsic value per share, they're saying is $4.41. So, and let's go back and have a quick look at what currently trading at. So it's currently trading at $1.95. So that's the current share price. So that's meaning it's saying from these calculations that currently that the stock is trading 55% below intrinsic value, okay? And that's including the 50% margin of safety, okay? So, but like I said, don't just use this as a buy now recommendation. I highly recommend you do your own research around this. This is just my sort of calculations from running a discounted cash flow on it. But like I said, I highly recommend you do your own calculations around this, especially around the growth rate as well. That's also a good, one you want to sort of do a lot of work on. Today, like I said, I've gone with 5, which has probably been slightly not so optimistic, but that's where I'm going with that today. So that's where they're saying with it. Let's quickly jump over to full Town's payback time, just to have a little look at there with his payback time calculator. This is how long it will take for the business to be paid back at current share price. Okay, so this calculator determines the number of years it would take the earnings of the company to cover the cost of the stock price you pay. Okay, another great website. I'll leave the description. I'll leave a link to the description below for this calculator. Highly recommend. This is just another sort of good indication of how long it will take for you to return your capital invested within the business. So we're going in with the earnings per share. Let's go back over to Yahoo here. And let's go into income statement. Scroll down here on the income statement, and then we're going to go for basic earnings per share. So 47 cents. Go back to our calculator. There it is, 47. Growth rate, again, I've gone with the 5%. Current stock price of $1.95. This is quite a super easy calculation to run. You can do it in a minute, basically. And then they're saying the current payback time is 3 years. Okay, that's how long it will take to return your capital invested with this company. And he likes to say, invest in companies that takes, 8 years or less. So there we have 3 years. The one thing, like I was saying about the growth rate, he prefers to have, a growth rate of more like that 10 to 15%. So that's something to bear in mind if you're wanting to invest in this particular business as well. So just put a bit of stock in that. Anyway, guys, hope you got some value from there. If there's any questions or anything I covered off on a bit too quickly there, drop it in the comments below and I'll do my best to cover it off on it. But we'll wrap that one up there. All right, guys, I hope you got some value there from the discounted cash flow analysis. If you've got any dramas with anything there, or anything that I sort of covered off on, drop it in the comments below and I'll do my best to get back to you on anything that you sort of might not have understood there. Love to know your thoughts on it. Like, what are you guys' thoughts on MCK? Are you pretty sort of bullish on it at the moment? Do you see it as being undervalued? How do you see those calculations? How do you sort of see the growth rate for the company as well moving forward? I was probably being slightly under there, coming in at 5%, but that's just sort of my take on it. I'd rather be a little bit reserved than overly optimistic on my calculations as well, just to give myself a little bit of a margin of safety as well. And I recommend that whenever you're doing any intrinsic value calculations of a business, always sort of err on the side of caution rather than being overly optimistic, okay? Giving yourself another sort of margin of safety there. Anyway, guys, hope you enjoyed the video. Like I say in other videos, if you enjoy the video, it'd be much appreciated if you hit that like button, okay? Helps me out heaps, helps push these videos out a bit further, especially for a new channel like myself. It gives me good motivation to keep moving forward and making these videos. And if you want to see some more videos like this moving forward, then hit the subscribe button and you'll be the first to know when the next video drops. Alright guys, stay safe out there and we'll catch you in the next video. See ya.